Okay, picture this for a moment. It's April 1919. The stock market is really buzzing.
Yeah, a lot of activity back then.
And this new company, Savoll Tire, it just hits the scene. First day trading.
What happened?
The stock price just skyrockets. I mean, an unbelievable 250% return for anyone who got in early.
Wow, 250% in a day, you'd feel like a genius.
Totally. Like you just struck gold, right? But, hold that thought.
Oh no, I sense a catch.
Because just 6 months later, that same stock, completely worthless.
Worse, what was
Starts out the whole thing, the entire operation, was just a sham, a complete fraud.
Oof. That's brutal. And you know what's fascinating about that whole Savile Tire episode, that dramatic rise and fall,
Yeah.
is how it apparently really stuck with a young observer at the time, a guy named Benjamin Graham.
Ah, the man himself.
Yeah.
Who would later become, well, a giant in the investing world.
Exactly. And that whole Savile Tire story, it's kind of the perfect springboard for our book talk today. We're looking at Graham's really enduring work, The Intelligent Investor.
Right. And we should be clear, this isn't just some dry, dusty old finance book. Forget abstract theory.
Not at all.
It's really a practical guide. And remarkably, it still offers such valuable insights for, navigating the stock market today, which can be just as unpredictable.
And Graham knew what he was talking about because he wasn't just an academic. He was right there in the trenches of Wall Street.
Yeah, he started right at the bottom, right? As a clerk.
Started as a clerk, worked his way up, proved himself as an analyst, became a partner.
And eventually ran his own investment firm. Very successful one, too.
Absolutely. And you can really see that real-world grounding in his approach, especially his incredibly thorough research.
Okay, like that famous example with the pipeline companies.
Exactly. Back in 1925, I think it was, he was digging deep into the financial reports of these oil pipeline companies. Standard stuff, maybe?
But he found something unusual.
He did. He zeroed in on one called Northern Pipeline Co. Now, the stock was trading around, what, $65 a share?
Okay, seems reasonable on the surface.
But Graham looked deeper. He found the company held high-quality bonds, assets on its books, worth at least $80 per share.
$80 per share in bonds when the stock was trading at 65.
Yeah, a huge gap between the market price and the actual underlying value held by the company.
So what did he do? I mean, spotting that is one thing.
Right. He didn't just notice it and, write a note about it. He acted. He bought the stock.
Okay, makes sense. Buy low.
But then he went further. He actually started engaging with the company's management actively.
Really? What, like writing letters, calling them up?
Pretty much. He persistently pushed them, arguing they should distribute more of that value to shareholders, increase the dividend payouts.
So he was basically an activist investor, pushing them to unlock that hidden value he'd found.
You could definitely say that. He wanted them to recognize the true worth of their assets and share it. And guess what happened?
It worked.
It took a few years, about 3 years, but yeah. His initial investment at $65 grew to $110 per share.
Wow. That's not just finding value. That's actively making it happen. That's serious digging.
Absolutely. And that dedication, that meticulous analysis, focusing on the fundamental worth of a company, that really became the heart of his whole investment philosophy.
Which he lays out in The Intelligent Investor.
Precisely. Now, it's also helpful to remember the context, the market conditions, when he first wrote this book decades ago.
Wait, this was after World War I.
Yeah, the aftermath of World War I. It was a period of pretty significant market swings, ups and downs, as the economy and the world adjusted to peacetime. A return to normal, but normal included big drops as well as rises.
And, okay, here's where it gets kind of spooky almost. Because when you read Graham describing that market environment, the sharp rises, the speculation, these bubbles forming, and then the inevitable crashes. It sounds uncannily familiar.
Doesn't it? Just, you think about more recent history.
Like the dot-com boom and bust,
Yeah.
late 90s, early 2000s.
Exactly. That irrational exuberance, the crazy high valuations for companies with, frankly, little or no actual earnings, sometimes no revenue.
Just pure speculation, hoping the price would go up tomorrow.
And Graham saw similar patterns decades earlier. It connects to this bigger picture, maybe a recurring human tendency in markets.
What do you mean?
Well, Graham himself pointed out that after these periods of intense speculation, the market eventually kind of finds its level again. It returns to normal, as he put it.
Which means investors have to be ready for both sides of that coin, right? The big gains, but also the potentially painful losses.
Absolutely, you have to be prepared for the volatility. And it wasn't just, the average Joe getting caught up in the frenzy back then.
No, professionals too.
Graham specifically noted that even professional investment funds, people who should know better, sometimes got swept up. They'd chase these clearly overvalued, trendy stocks.
It's like a magnetic pull, that enthusiasm.
It really is. And Graham saw it as a timeless warning, actually, the danger of unchecked enthusiasm in the market.
Which raises a really interesting question. Why? Why is it so hard to resist that kind of market mania when it happens?
Yeah, and Graham tackles that head on. He suggests something quite profound, I think. He said that while enthusiasm is fantastic, it's a powerful driver for success in almost every other part of life.
Right, you need passion, drive.
But on Wall Street, he argued that enthusiasm almost invariably leads to trouble, maybe even disaster.
Wow, that's a strong statement. Enthusiasm leads to disaster on Wall Street.
And history kind of backs him up, doesn't it? We see that pattern again and again.
Yeah, definitely. That lure of quick riches, easy money,
Yeah.
and also the fear of missing out.
FOMO. It wasn't called that then, but the feeling was the same.
Exactly. That FOMO we hear about constantly today just clouds your judgment, makes rational decision-making really difficult, even for people who've been investing for years.
And that brings us right to a really fundamental concept in Graham's book, his definition of what makes an intelligent investor.
Okay, so what is it? Is it about having a PhD in economics or some secret stock-picking formula?
Not at all, actually. And this is what's so insightful. It's less about brain power, less about IQ, and much more about temperament, character.
Temperament. How so?
He defines the intelligent investor as someone who is, first off, patient, disciplined, always eager to learn, constantly refining their approach.
Okay, patience, discipline, learning.
And critically, it's about having the emotional strength, the fortitude to control your impulses, to not panic sell when things look bad or get overly greedy when things look amazing.
Controlling your emotions. That sounds simple, but it's incredibly hard in practice, especially with your own money on the line.
It's probably the hardest part. And linked to that is independent thinking. Having the ability to think for yourself and avoid just blindly following the crowd, whatever the prevailing sentiment is.
So it's not about being smarter than everyone else.
No, it's about being more disciplined, more rational, more emotionally grounded than the crowd. Character over intellect, in many ways.
So, okay, let's try and boil this down. What does this really mean for you, the listener, trying to navigate investing today?
Well, I think it means that successful investing, according to Graham, isn't really about trying to hit home runs all the time, or predicting the next big thing, or perfectly timing the market's peaks and valleys. Nobody can do that consistently.
Right. It's impossible.
Instead, it's about cultivating a specific mindset, a way of thinking. It's thoughtful, it's analytical.
Focused on the long term.
Exactly. Prioritizing long-term value creation over chasing those short-term speculative gains. And Graham's book, The Intelligent Investor, it remains just a foundational text for helping you develop exactly that kind of mindset.
It gives you a framework, maybe?
A framework, a philosophy, yeah. And it's not like you read it once and you're set for life. The market constantly throws new things at you, new challenges, new temptations.
Always something new, some new narrative.
Always. But Graham's wisdom, his principles, they provide this enduring way to navigate all that complexity. Not with, perfect foresight, but with discipline, with a rational perspective that's rooted in understanding value and maintaining a healthy skepticism about market hype.
Okay, so maybe a final thought for everyone listening. As you think about your own approach to investing, really consider Graham's definition.
Yeah, ask yourself.
Are you letting yourself get swayed by the fear of missing out on whatever the hot stock of the moment is?
Yeah.
That buzz?
Or
Or are you genuinely focusing on a patient, disciplined, analytical strategy? One that's really aimed at building wealth steadily over the long haul?
that's really the core question, isn't it? It's less about what specific stocks you pick.
And more about the why and the how, the principles guiding your decision.
Exactly, your process, your temperament.
Well, this has been fascinating. For more insightful discussions and book talks like this one, exploring classic investment principles and strategies.
Yeah, be sure to subscribe to the channel.
Definitely subscribe. Lots more to come.